How's it going, everybody? I am Palosh, and in this video we'll be talking all about options trading, what options represent and how they work, in order for us to have a better financial education and to become more knowledgeable investors or traders. So fellas, what's an option? An option is a contract which gives the buyer the right, but very importantly not the obligation, to buy or sell an underlying asset, that's stock in a company, an ETF or an index, at a specified price until a specified date, depending on the form of the option. In other words, buying an option is betting that a certain asset is going to rise or fall in value, without taking as much risk as buying the asset itself. The selling of options can be seen more simply as selling insurance, but we'll discuss this in more detail when we talk about the kinds of options. Now that we know what an option represents, let's take a look at the most fundamental types of options: calls and puts. So, let's start with call options. A call gives the buyer the right to buy an asset at a certain price, higher than the current value until a specified date. And you, beloved viewer, might be asking yourself, but why would anyone do that? Why would you want to buy an asset at a higher price than it's trading right now? And on top of that, pay a fee for the contract? No. Why? Well, let's take a look at an example. Let's say Tesla is trading at around $2,000 a share. And you've seen Cathy Wood a couple of times on TV and you think it's gonna go to $7,000 soon. Well, you could buy a call option for $100 a share that gives you the right to buy the stock at $2,100, effectively getting it for $2,200 if you choose to use your right. If the share price rises above $2,200, you can at any point decide to buy the stock at $2,100 and you've made a profit. But let's say Elon Musk starts tweeting that his stock is overvalued, as he does sometimes, and it drops to $500. Well, you're much better off now than you would have bought the shares themselves. All you've lost now is the $100 you paid per share for the option, which is much less than the $1,500 you would have lost if you would have bought the stock. To summarize, buying a call is betting that an asset goes up in value. If you sell a call option to someone, you make money from the price of the contract itself, effectively selling insurance in case the asset goes up in value. If the asset price does rise, you're obligated to buy it at the current price and sell it for less, and you lose money. Now that we've discussed calls, let's start talking about puts. As you can imagine, a put is pretty much the opposite of a call. A put option gives the buyer the right to sell an asset at a certain price, lower than the current value, obviously the same as the call, for a fee. That's useful if you think the price of a certain asset is going to go down in value, effectively shorting it. This is a way to short an asset with much less exposure to the risks associated with shorting, also known as losing all your money. People who sell put options are obligated to buy an asset at a specific price. Much like call options, this is pretty much selling insurance. But in this case, it's insurance in case the asset drops in value. Selling a put can be a great way of buying an asset at close to its trading price, all of that while collecting a premium from the buyer of the contract. To summarize as much as possible, if there's one thing to take away from this video, is that buying calls and selling puts is a way to make money if the asset goes up in value, while selling calls and buying puts is a way to make money if the asset goes down in value. If you've enjoyed this video, found it entertaining or learned something, leaving a like would make my heart warm like a hot stove in the winter. And subscribe if you're interested in any types of videos I make. Thank you.